And on that day, an epic event occurred that cast a long and delicious haze across the land. Eclipse was born. Eclipse is a new addition to the spectrum of Aussie flavour hops from the country's leading grower, HPA.
Good evening, I'm Matt Kierkegaard, editor of Australian Brews News, and tonight we're here to discuss brewery valuations. The Australian craft brewing industry has seen much activity in recent times. Acquisitions in the space have heated up as larger players look to expand, and local brewers have begun tapping capital markets. Many local craft breweries have raised private capital to fund expansion, including utilising crowdsourced funding. But how does a business value itself, whether for sale or capital investment? To discuss that issue tonight, I'm joined by my expert panel that includes Peter Bishop, Managing Director of HLB Chessboard. HLB Chessboard is a corporate advisory firm providing strategic advice to assist businesses at all stages of their business lifecycle. Peter has particular expertise in advising businesses in relation to mergers and acquisitions, capital raising, valuations and IPOs. Welcome, Peter.
Hi, thanks for having me.
I'm also joined by Paul Fraser, National Director of CBRE Hotels Investment and Brokerage Team. He specialises in all asset classes across the hospitality industry. Paul's core focus is across large-style pub, tavern and accommodation-style assets across the state. Paul, welcome to this Brewery Pro Live.
Thanks for having me.
And finally, I'm joined by Matt Vitale, co-founder and Managing Director of Birchal, which I'm sure needs no introduction, but I will anyway. Birchal is licensed under Australia's crowdsourced funding regime, and since 2018, Birchal has helped over 100 Australian businesses raise over $70 million from their most passionate customers and fans online. Welcome from Melbourne, Matt.
Thanks for having me.
Now, as we said, we're here to talk. Now, for those watching on Facebook, which is the only place you can watch us, we will be taking questions from you. So if you've got any questions as the conversation takes place, you can post them in the comments and they'll be relayed to our panel. Now, Paul, the first question for you. Sure. I guess we haven't seen that many breweries sell in Australia. We've seen some very notable ones recently.
Yeah.
But we do see a lot of hotels, which is your area of specialty.
Sure.
If I'm a hotel owner or I'm looking to buy a hotel, do you set the valuation, or is there a standard formula that you use when you're looking? Tell us a little bit about how hotels value themselves.
Okay. So as an agent, I'm generally asked to go and obviously meet whoever owns the pub and provide them with some sort of proposal that will include what we call a broker's opinion of value. So there's a certain methodology that we'd use as brokers going through that. So generally we will look at, obviously we'd be provided with profit and loss. We would look at how the turnover is, the revenue across the different streams of the business. It may just be a food and beverage operation. It may be food, beverage, retail, gaming, could have accommodation, etc. So we'll take a lot of those factors into consideration. We'll have what you call, I guess, a clean profit and loss. So owner operators, one example might be they might have a motor vehicle, their own personal motor vehicle that they're using that's run through the business. They'd add that back.
Okay.
We drive down, I guess, the profit and loss. We check benchmarks to, we'll see abnormalities if wages are incredibly high or incredibly low. We're pretty diligent on that sort of stuff. We see P&Ls every day, so we get a really good idea of what they should look like, what the profit to revenue, percentage should look like. We get that, I guess, that profit, that EBITDA number at the end. That will be either, if it's a freehold going concern, no rent. If it's a leasehold, there's obviously rent. So what we'll do on an EBITDA net profit point of view, we will look at that, and then we'll look at comparable sales that have taken place. And we will match that, whether it's, location-wise, is it Southeast Queensland, is it New South Wales based? Byron Bay is obviously incredibly hot at the moment. What are the cap rates on that? And we'll apply what we believe is a comparable asset that is sold recently to that, and that will produce what we believe is the rough value of that asset. If it's a leasehold, a little bit more complicated. You've obviously got the lease, you've got a duty and obligation to the landlord, that will come into it. What do yearly ratchet increases look like? What is the rent to as a percentage of net profit? What does that look like? Is it sustainable? So there's quite an intricate amount of detail that will go into that. It's quite an arduous process. But at the end of that, you should be able to go back to a publican and go, your asset is doing X amount as a maintainable profit every year. These are the venues that have sold in a comparable location. Some may be slightly superior, some may slightly be inferior, and we say, right, that's your cap rate on that amount, and therefore there's your value.
Okay. How consistently priced? Like, can you pretty much accurately guess how much or work out how much a hotel will be worth, or is there a price versus value proposition?
Yeah, so I've been doing this for 12 years, and I thought I was getting better. I felt like I was getting better at it. And then the market has turned, I'd call it aggressively in the last certainly in the last 18 months, maybe even 24 months, where some of these sales that have occurred, when you look at what the like I said, what the maintainable EBITDA is and the actual value that they sold for them, there's a real disconnect there. Mm-hmm. And sometimes that comes to an emotional buyer. It comes down to someone who maybe owns a pub in, a competing pub next door that sees the economies of scale with it, just needs that as the last piece. Sometimes it's a generational play. Honestly, sometimes there doesn't seem to be a rhyme or reason to it. They would be the 5, maybe 10% of the assets that sell. Sometimes fall on that. 90% of the time, I would suggest that an asset comes across my desk. I can analyze it. I can say, look, there's the banding that it's going to come in, and I'd say with a 90% accuracy, should be able to. I'd be getting it right where it falls.
Okay. How much guidance can somebody that owns a brewery, and the 540 odd breweries in the country, the vast majority are brew pubs or smaller with a significant portion of their revenue coming through their own over the bar sales.
Yeah.
Should they be looking at themselves, as breweries, or should they be looking at themselves as more hospitality ventures? I mean,
look, I guess a lot of it comes down to size and scale. So I think there are a lot of pros and cons with having your own brewery in your own pub. It's very parochial to that area. It can be very parochial to that area. You get high levels of engagement. You've got patronage coming in because he or she is a local brewery producing a great product for that region. A bit like farm to plate or paddock to plate. It's that same sort of ethos that rightly so, the catchment buy into it. So that helps revenue. That obviously, the COGS, the cost of goods is obviously a pretty powerful tool as well. You buy a keg off a brewer. Let's call it $300. If you can produce it for $150, you're saving half your COGS there. Better on the GP. That to me is a great story. It's a strong offering to the market. Mm-hmm. The negative or the con on it is there is a lot of IP or perceived IP that is tied up in that. So, you know, if I look at the vast market out there, is your average pub buyer going to look at a microbrewery? I genuinely think if they're not in that market to start with, it has some drawbacks in it because they don't know what they don't know. So they can get an understanding of food, they can get an understanding of beverage, mainstream food, mainstream beverage, gaming, etc. And they understand where the profit comes from those revenue streams. Once you start talking about you're actually going to be brewing your own product here, a lot of them will switch off on that and just go, this is almost in the too hard basket.
Okay.
Can I add to that?
Absolutely, Peter. I was going to come to you. And how closely does the businesses, because you value businesses broadly, and how closely does hospitality fit in with the broader investment and business valuation model?
Listening to Paul's answer, it kind of shows the confusion that I think's out there with valuation around the industry in total. So you talk cap rates. Cap rates are property-based valuation, where you're looking at the return on an asset, and they're generally freehold assets. So you can see why cap rates become a discussion for people in pubs when they're freehold.
Yep.
But to me, brewing is about a brand and a distribution capacity, something far greater than a pub may ever be able to achieve. So then you're talking about a standard business with potentially a lot more growth profile, which is what I'd say is the attractive side of a brewery, apart from the obvious. And so then you've got to actually start talking about standard valuation methodologies around going concerns. And that is, there's only one method. I know I make things too simple, and lots of us have made careers around making valuation very complicated, but it's the net present value of future cash flows. That's it.
Yeah.
If you're thinking about an investment, you're looking at the future potential of profits to yourself, or earnings, EBITDA, EBIT, whatever line you want to pick, and what's it worth to you today in association to the risk to achieve those.
So is that to the owner or to the buyer? The
Both.
future?
So this is the complexity that I think's entered this industry is that we're talking pubs, but we're talking breweries. I see them slightly differently as far as growth profiles go. One's a going concern, hopefully with less capital requirements. One's got a lower yielding type asset in it, being land and buildings.
Yeah.
So first, I see a separation like that.
Okay.
Then I see
And I'll just stop you. I would have thought that establishing like the land value would be a little bit easier because land value would be a little bit more concrete.
It's an interesting point. I think the issue. I'll say this as tactfully as I possibly can. If you own a pub, and exactly what Matt was saying, or Peter was saying just before. If you're valuing a pub and you're looking at what that cash flow is going to produce and you put a value on it, that is absolutely the way that a business or a property should be valued. Correct, 100% correct. On the flip side, if you're looking at a pub and you're valuing it by its underlying intrinsic value being the land that it sits on, the building, the fittings, fixtures, equipment, which 5 cents, I'm being facetious, 5 cents in the dollar, 10 cents in the dollar, whatever that would do, that's not a good position to be in. So when I look at a pub and people say that pub sold for 20 million and they say, oh, but the land would be such a small percentage of that value.
But it would be a relatively concrete, definable, because then all of the earnings, looking at the multiple income streams, would be where you start getting that higher value. Is that correct?
So I'm not talking about where you attribute value.
Okay.
I'm talking about methodology of valuation.
Sure.
So as a pure investor wanting to make a return on their investment, you're looking at the future cash flows that it can provide you. If you can do that in a technology company that requires $1 investment, and you can make tens of thousands of dollars into the future, well, lucky you've done it on a lower cost base than something that requires land and buildings.
Correct.
Okay.
Yeah.
So because traditionally it's a freehold asset, property valuation comes into the mix, which is talking about cap rates. yields.
And I think the other really important point on this part of the discussion is that it's great if you're emotional and you want to buy a pub, and that's fantastic, and hospitality is in your blood. That's great. But behind you, whoever you may be, is going to be a financer who's talking to a bank or a bank.
Okay, and we might, that's something we might sort of park, because I really want to throw the cat amongst the pigeons in terms of future income and bring in Matt Vitale. Matt, tell us, you've heard the basic valuations. The valuations that we've seen for the crowdsourced funding model have been much higher than potentially the perceived value of businesses are. And a lot of that is because they're early stage businesses looking very much at future earnings. Is that correct?
Look, I don't know that I'd necessarily agree with that, Matt. Like, you're putting a view that they're higher than others, but for the first time, these businesses have been offered through crowdsourced funding, and the reality is, we only have a few data points or comparable transactions to look at. Maybe if I can step back a second and just talk about what changed when the equity crowdfunding rules came in. The first game changer is that proprietary limited companies can have a potentially unlimited number of investors, which was a really fundamental change to corporate law, where previously you'd need to convert to a public structure once you got over 50 non-employee shareholders. The second, and perhaps the most significant, is that these offers can be advertised online. And what that does is it expands the universe of potential investors into a deal, from deals being done behind closed doors with a small kind of definable group of investors that will be looking at an opportunity to potentially anyone with a smartphone. And that presents a range of opportunities for businesses that have a strong consumer proposition, and craft brewers, craft distillers are supremely positioned to do well with crowdfunding. And I've heard it said before that if you're trying to sell a product and you can't advertise it, and then all of a sudden you can advertise it, naturally that would put some upward pressure on prices.
Can I jump in there? I think that's the perfect segue. So where I was going with that is it gets confusing because people mix up price, which Matt just said, and value. So you come from this traditional market where there's cap rates used. You're actually talking about more of a going concern asset now, where you've got higher growth opportunities with distribution capacities and branding and all those sorts of good things. So all of a sudden you move into the world of standard valuation practice. There's one. There is the net present value of future cash flows. What people try to do is they use EBIT multiples and EBITDA multiples to simulate that as a shorthand version. But what happens when you're in an early stage venture, if you use a multiple, you're only putting a multiple on what you call a future maintainable earning.
Sure.
And how do you pick that? So that's why it's even more important to think about the forecasts of this business moving forward, so that you can try and capture some of that value and support it in the price. So what's happening is you want to have an evaluation of your business all the time, because one of the key aspects, I hope, as a director is to try to increase shareholder value, amongst other things. And so you've got to know every decision you're making is contributing to that, and if it's not, why not? Because there's other factors to consider, to prioritise. So what Matt's talking about is price. He's saying you put it out there to the public, who are understanding that they might have a thousand other reasons to enjoy this asset. They might want to support it, they might know the people, it might be something that they think's really cool and want to be part of. That's called special value.
But it's being sold as an investment, which is one of those great challenges. And I'd invite Matt to jump in if he wants, because we had a crowdsource. Sorry, Matt.
Yeah, I will jump in there because, fine, you can call it special value, point out that it's been billed as an investment. But essentially, this is what markets do. every day of the week. And, even in the listed space around the world, we've got people that are scratching their heads at the way that, some of the biggest companies in the world are being valued, and investors are looking at things and looking at assets and opportunities in a different way to they have, ever have before. I'm not saying that, Tesla is, overvalued or undervalued, but just look at the, commentary on stocks like that we're in a new world and people are looking at pricing assets differently. What I would say about crowdfunded investors, though, many people think that it's just people that are perhaps less price sensitive and investing smaller amounts, and therefore they're not, applying the same amount of rigor to investing in these deals as others. That's not actually the case. So, every deal that we've hosted is made up of, some wholesale investors. Now, we only have to determine someone's status as a wholesale investor if they want to invest more than $10,000. So, the number of wholesale investors could in fact be more. They might just be investing less than $10,000. But to say that they're not applying the same, amount of rigor to these opportunities as others, I don't know is correct. And special value, while interesting as a concept, I'm not sure that it's entirely accurate here. What I think you need to remember is we provide a platform that for the first time makes it possible for businesses to, make their offers to a national audience. In the same way, these opportunities have been made available to all Australians for the first time. So, people ultimately need to make up their minds as to what is interesting to them as an investment. And all of these, considerations on valuation methodology are absolutely relevant. But this is something that I think we're only, going to, see normalise over time with more data points.
I might just sort of ask a quick follow-up if I could, Matt, because I appreciate what you're saying. A lot of the CSF businesses that have raised money under that are only in the last 2 or 3 years. But, for example, there are breweries that have been on sale online, so effectively reaching the same pool of potential buyers as someone who's invested through a CSF. And there are businesses that include freehold land as an underpinning value that are selling for a tenth of what the value being put on the CSF valuations. Is that a fair comparison to look at a brewery that's selling with the brewing equipment and even potentially land that has a turnover and recognisable value, with a business that is essentially unproven with a hope of earnings in the future if it survives in a fairly speculative and ever competing market? Matt?
Look, I mean, it's hard for me to give you the answer on that hypothetical as to which one is right, other than to say that every investor should assess an opportunity on its merits. And if I'm looking at the way that I assess some of these opportunities, it's traction, it's the strength of the brand, and my belief in the team being able to execute its plans, understanding where sales are going to come from, and how confidently they'll progress and execute on their plans. That's ultimately what I think. Looking at the replacement cost or the book value of these assets and kind of scratching your head why, the difference between those two opportunities is the people that are there operating the business. Like on the one hand, you're talking about brewery kit and land and all of these things, and that's not factoring in the people that are there actually running the business. And there must be a value assigned for that, and I think that's what we're seeing in crowdfunding. Now, whether it's too high or not, I think that's a matter for the market to decide over time. As a platform, and I need to kind of clear this up because people ask us all the time, do we actually value the opportunities before we open the offers? The short answer is no, we don't. We'll give feedback to companies, but that's probably one of the things that founders love most about crowdfunding is for the first time, they're able to set the terms on which they're happy to accept investment. And investors can invest or not. And that's really empowering for, a group of, small business founders that, haven't had a lot of bargaining power. And I mean, if we're talking about the tech space, there's been, a group of people that have been controlling the purse strings and, making kings or deciding who will be kings and who won't. And, even in the brewery space, and I know we're going to get onto bank finance shortly, but, for the first time, equity capital is available to a whole range of businesses that haven't been able to include equity capital as part of their funding mix, or if they did, the only people that they would be able to go to were the people that were setting the price and the terms. And,
Hey, Matt, I don't think equity crowdfunding's on trial.
Oh, no, I'm not.
What I think is that a business owner is trying to figure out what's going on. And just for everybody to know, Chessboard has a relationship with Possible, and we've done deals with Matt. We've taken clients there and worked with clients. I think it's an unbelievable opportunity that the government's given the world, and you've been implementing really well for 3 years. I think what my point is that companies should understand what's going on so that they can utilise it the best. And if I try to jump ahead about 14 steps, I actually think the risk is 2 to 3 years after a crowdfund for somebody. And what I mean by that is, of course, if you can go to market and raise something, I've seen somebody do something here at an implied revenue multiple of an 18 times revenue. As if you wouldn't, because when you're a founder and you're trying to raise capital, you're trying to figure out the value of the business. Hopefully you're talking to somebody like us, but more importantly, you're trying to figure out how not to get diluted. So if you can raise money at 18 times revenue, you're going to do it.
And that's what you
have to think about in the future is, will that interfere with the next raise and the next raise? And if I sell, can I get more than 18 times in that transaction? So I think crowdsourced funding is absolutely fantastic for the right business.
It's terrific.
I just think the valuation behind the price needs to be in their minds, in the owners' minds, so that they can figure out. Because if you look at this last deal that went through, and you believe the rumours, the multiples that they exited are at extraordinary. So why wouldn't you be raising money at 18 times now?
And I guess, I might just
jump in there quickly, right?
Sure.
Because I want to give you also some insight that we walk these companies through, so people can understand, what inside a crowdfunding offer looks like. We take companies through their capital planning for the future, and this is a point that I make to them, often, is that yes, if this is the only round that you will ever do, then then shooting the lights out on your valuation might be a great strategy because it'll minimise dilution. But if you see in your future that you will need more capital, then you need to be thinking about that. You need to be pricing in enough upside for investors to encourage them to come along for the journey, because crowdfunding should not only give you the capital you need this time, but it should provide you access to a pool of liquidity that you can continue to draw on into the future. But it's a great example because, Black Hops, I think that was, look, people raised their eyebrows. It was a pretty solid revenue multiple when we hosted their offer back in 2019, 400,000 in 6 days. And they've since gone on to raise from their existing investors off platform and continued to, show an uplift in value. And that business is probably about 10 times the size of what it was when they came to us at 1.4 mil of revenue, I think,
that's right.
During their first offer. So it's, we can raise eyebrows about this, but from time to time, it does work out for these companies. And, absolutely, businesses should be thinking about their future raises, making sure that they've got a capital plan.
I just wanted to step back and to the point about CSF being on, or crowdsourced funding being on trial, and certainly not, but I guess as an observer and hearing a lot of the observations in the industry, when the only valuations that we see are big sales like Stone and Wood and the rumoured sales and the Bolters of the world, and then the equity crowdfunding valuations, I know that there are a lot of people being drawn to the industry, seeing a pot of gold ahead, and we haven't seen any, we've not seen any breweries with a $2 or $3 million turnover sell, which, Matt, is one of the reasons why interrogating the valuations around crowdsourced funding, I think, is a valuable exercise to set market expectations. So, Paul, one of the things that you were saying is that there's a reluctance in some finance, amongst banks to lend to breweries at the moment.
As an overall, I mean, the landscape changes. I'll just qualify a little bit. The landscape changes and can change weekly on where banks will look at and where they won't. And but at the moment, I'd say it's fair to say that if you were going to walk in the front door as an unknown, unproven performer in the craft brewing space and say to the bank, I want to build a brewery, I'm going to buy the equipment, it's going to cost me $2 million and I want $1 million, I want a 50% loan to value ratio, I think it's going to be unlikely that the banks are going to be receptive to that sort of conversation. Versus if you are a known publican, you already have a cash flow business, it's already got a valuation, and you sort of go, you know what, I'm actually going to add a brewery to my existing operation. I already have cash flow, I already have revenue coming in the door. I'm going to spend the same amount of money, per se, $2 million, but this is what it's going to look like on my current cost of goods. This is what it's going to do to my GP. I'm going to farm it out to my bottle shops, etc. I'm going to have a canning line, whatever it might be. That more robust business plan, I think, will get more of a receptive nod potentially from the banks out there at the moment than in the current landscape, where there are a lot of people wanting to get into that craft brew, and for all the right reasons, I will say, Matt. Like a lot of people, and to your earlier point, craft brewing is an exciting space to be in for investors, and some of the multiples, we can question a lot, but I think the thing about it is it's an it can be very emotive, right? It can capture that emotive piece. It's a lower price point generally when you're coming into it. It's incredibly scalable as a business. So once you have the equipment to add on and increase your volume is relatively easy to do. And frankly, from a macroeconomic point of view, we under-index as a nation on craft beer. Like, that's a fact. Versus America, our volume of craft beer is still incredibly small. So the size of the pie is big. So absolutely, I understand why people can look at, black hops, for instance, Matt, etc., and look at these businesses and go, okay, I'm going to buy. I'm going to buy at that price. I'm going to take a piece of it because, frankly, I live in the area, or I've had an experience with black hops. I like the product. All of those reasons that I've said before. From a macroeconomic point, we're under-indexed, very scalable, etc. I get it. If you're going to go in though, and to my earlier point, if you're going to go in and walk into a banker and say, I want money for a brand new craft brewery, no experience, no knowledge in the space, but this is what I want to do, I think you're going to find it difficult.
Can I add to that? So when we take our corporate clients to banks, in the old days, people cared about the banks cared about security and then serviceability. It's the other way around now. They care about serviceability first. So they'll walk in and go, oh, okay, 50% of the asset, we can understand that if you're going to sell that asset, we'll probably get 50% of the, 50 cents in the dollar back.
Sure.
So therefore, that's all right. We should do that deal. My understanding of the banks nowadays is more that they're worried about serviceability. So if you're not producing a lot of earnings, they start to get a little bit wobbly at the knees. I'm a data bloke, so can I just give you some maths, guys? So this morning, my team ran listed breweries in the world. There's 86 of them, I think, about 86, and the median EBITDA multiple that they're trading at is 12.7. So
just talk us, for listeners that probably, or viewers that potentially don't know EBITDA and what that captures.
So EBITDA is start at profit before tax, and add back depreciation and amortisation. So it's quasi-cash. It's supposed to represent the cash being generated from the business, which you can then use to pay debt or to pay whatever you need to pay. So a bit more valuation theory, if people care, is comps is where Paul started, property pub comps. That's the way we work as well. We're looking at multiples or discount rates on future cash flows of people in the market. Now, 12.7 shouldn't be what this craft brewery, early stage looks at, because they're smaller, so there's a discount for that. These guys can be valued up to $100 billion. There's liquidity, they're listed, so they get a premium for that because an investor can get in and out quickly, so that has another premium attached to it. But then the founders, when they're looking at these businesses, control them. So they might get to add a control premium on. So there's some massaging to do, but it's interesting to note that as at today, the brewery industry around the world, as big as the companies are 12.7.
Okay.
And out of interest, the last 20 deals that were announced, mergers and acquisitions, there's been 87 of them in the last 5 years in in globally listed businesses, and they've transacted at 11 times. So that's actually more comparable other than a discount for size. So.
Paul, have we seen many hotel groups say crowdfund versus sale or invest? How does that market operate?
Not necessarily crowdfunding. I mean, there's certainly a lot of funds that are out there, and actually becoming more prevalent every year. I mean, if you take Australia as a whole landscape just now, I mean, it's well known, well publicised that there are the two biggest players are AVC, that was a JV with Coles, ex-West Farmers. It becomes more and more confusing, but AVC and ALH, which is now Endeavour, which was with Woolworths, which demerged, etc., etc. So they're the two, obviously the two bigger players, or the biggest players in the market, and what we found is there has been more consolidation as the years go. I mean, I've been doing this for now 11 years, and every year, there is more consolidation in that market. So in answer to your question, what has happened is a lot of private equity guys have banded up with operators that have sort of said, I think it might have been Matt that mentioned it before, that a lot of these pubs, pubs are high, funnily enough, high cash flow, high liquor establishments, which means that you have to be there is not a lot of margin for error. Good publicans will thrive in that industry because there are so many things that you need to be over. You need to be, head of your HR. You need to be hiring and firing. You need to be controlling the quality. There are so many fail points in a pub and so many different revenue streams that you need to be all over it. So private equity rightly have looked at this, and a couple of them have come in early on and thought that they could do it, and thought we'll just buy some pubs, and have been, it'd be fair to say, have been burnt, not from a publican background, have been burnt and disappeared. And now we're seeing a lot of that private equity sort of funds come in and marry up with strong public. I mean, AVC is backed by KKR, one of the biggest private equity funds that's out there. So that model is continuing and is getting stronger. So, I mean, I deal with a lot of the funds nationally now, Sydney and Victoria, that are now looking at coming up. Not so much the crowdfunding. I mean, I know obviously Matt with the Speakeasy Group has done a crowdfunding on a group, but that is less prevalent just now as to private equity out there chasing.
Okay. And I think you've got to actually make the dissemination between the investment, the investors that you're looking for at what stage of business you are. So the very early stage, pre-profit, very small revenues, it's a crowd fund. It's asking people to help them get to a certain point. These enormous groups, pub roll-up groups, private equity backed, are way down the other end. They're not going to talk venture capital.
And that's what I was going to bring
up. And then
there
are venture capitalists that sit in the middle, which my personal thought as a capital raiser is, let's go for some crowdsource funding, if you can get it, and then get to the point where a venture firm might be interested, an institutional investor. And I actually have a question to you guys and anybody else who's listening. I don't know venture firms who are in early stage breweries yet. I'm looking for that.
I'm not aware of any. The only
I know
one-
there's wholesale investors, high net worths who want to put more than 10K in, but I'm not sure about instos yet.
Without having thought about it, the one that I can think of is Mitre Craft, which is a publicly listed accelerator that is invested in a number of breweries and has gradually been upping its stake. But again, I don't have their values in front of me, but that's I think the closest thing we've got. And with the vast majority of breweries in Australia being candidates for Matt's crowdsource funding model or full sale, which is really where we're coming at with this panel. Now, just a couple of questions have come in from the discussion group. Jason asks, and this is probably for you, Paul, what impacts have you seen COVID have on valuations, particularly in Melbourne and Sydney?
Yeah, okay. That's a good question. That's an ever-moving, sort of an ever-evolving beast, unfortunately. I will say this, that when we were first talking to valuers, and I talk to them every week, when I was first talking to them, they took a methodology where I'll try and do this as simply as I possibly can without people's eyes glazing over. But let's just keep it really simple and say a pub is making $1 million worth of EBITDA, net profit, and it has a 10% cap rate on it. So it's a $10 million value prior to COVID. So what the valuers were then looking at was they were going, right, the only way that we can do it, because it's such an extraordinary event that has happened, we don't know when it's when it's going to finish, we don't know what it's going to do for the business overall, or the industry for that matter. We're looking at it as a cash flow interruption. So what they would look at is they would say, right, we are going to, effectively what we're going to do is we're going to keep your cap rate the same, 10%, right? What we're going to do is we're going to keep your maintainable EBIT prior to March 23, which is when the lockdown occurred last year. We're going to keep your EBITDA at that $1 million, and we're going to still value it at 10 million minus 6 months of cash flow, which is $500,000. So that valuation, if you were, I guess, unlucky enough in that first sort of 3 or 4 months to have to get a valuation for finance purposes or whatever it was, you weren't getting penalised significantly. To the point, what you were getting is you were getting that $500,000 or that half a year's earnings deducted off as a straight cash flow, as a straight cash flow disruption. I think, unfortunately, Melbourne is unfortunately, had the horrible title of being the most locked down city in the world because of COVID. I will say this, as far as talking from New South Wales and Queensland point of view, New South Wales opened a month, you may or may not remember, New South Wales opened in June last year after we shut on March 23rd. It was actually a month before. Queensland opened on July the 3rd, I think it was July the 3rd or 4th. And what we saw there on pubs that opened straight away was there was a huge spike across the revenue streams, which obviously filtered down onto their bottom line. So the rebound was quick and effective. So fortunately, a lot of publicans I guess they've had to wear those 3 months or 2.5 months to 3.5 months, depending on what state you're in, out of New South Wales and Queensland. But you've bounced back strong, which has been a great thing. So now I'm seeing that valuations, have been some really strong sales recently that have occurred with incredibly strong tight yields that I don't believe that you're going to see any significant difference, or certainly not going to go backwards on your valuation. Victoria, incredibly tough. They've been. I don't know how many days it is now that they've been in lockdown, but it's a considerable amount of time. That's obviously creating a headache, and I think there has been a lot of deferrals of valuations on that front.
Jason, There's a thing called the Australian Property Journal that's just released a paper on it.
Okay. So we might have provide a link to that in the show notes we publish afterwards. Matt, how about you? We'll just bring you back in. Have you seen, we have seen a bit of a rush of CSF or crowdfunding campaigns over the last 18 months. Do you think that has been COVID related, or has that just been course of business?
Yeah, look, I mean, we were on a really strong growth trajectory towards the end of 2019. You know, it came back after Christmas, looking forward to another big year, and then like everyone, you know, COVID just disrupted everything. And I think after a brief pause, you know, we'd opened an expression of interest campaign for Hawker's Beer, which we were really excited about, but it didn't make a lot of sense raising money. I mean, they were building a tap room, you know, Marsden, you know, told us it didn't make a lot of sense raising money for a tap room when we didn't know if tap rooms were even going to be a thing back in, you know, March, April 2020. But after a brief pause, we were able to get a few deals away, and then I think we showed that crowdfunding was still open and it was still possible for companies to raise capital. Ours is an entirely online process, so, you know, a particular advantage became very attractive to people, you know, who had other plans and couldn't execute them. And now we're back to, you know, I suppose what you would expect in a growing crowdfunding industry. You know, we look at the UK and the US as relevant precedents for Australia, and we're expecting the industry to grow. You know, it doubled year on year, and we're expecting that to continue at least for the next few years.
Another question from the chat room: dollar per litre metrics in the brewing industry. You're not able to answer that. So if you're able to work out, I presume it's a dollar production cost per litre. Whether that's something that you can scale. We might just sort of get Stephen to clarify that in the chat room if that's what he was after. How appropriate are dollar per litre metrics for brewery transactions? I guess you know, either the value per litre produced, maybe the other thing he was looking at. So I think when ABI were active in the market in Australia, they were looking at, you know, the value of the brewery based on the number of hectolitres of beer produced. But
I think mathematically it works. Again, it's all about potential future cash flow, and your cash flow is constrained by your litre of capacity, and so therefore there's a direct correlation between litres revenue. If you're operating at standard margins, then you can back solve it. So these are all those sorts of things. Are good back of the envelope style checks of the real way of doing it, which is future earnings.
With future earnings, we're in a market that, as we've identified, is very exciting, a lot of new players, but it's also a highly concentrated market with two major players, two major retailers, more people coming in. How do you calculate, you know, projections for future earnings?
Well, I think it's actually capacity based, isn't it, for the brewing industry? I think for me, if I was starting out and purely thinking about how to increase the value of something, we've had the price versus value discussion. Value is going to be something that spits out of the future forecasts, as accurate or inaccurate as they're going to be, but you've got to have some sort of basis to start the discussion. But then it's about when you see these unbelievable potential multiples that are being paid for things recently, I think you've got to understand where the special value comes in, but in terms of why was it specifically so important for that business to acquire you? Did it plug a hole? Did it solve a problem? Was a competitor killing you in that space? The big boys. So if you're preparing something for exit, you know, the private equity guys are the best at it in the world. They are sitting there and they've already orchestrated what the exit looks like and who it's to and what it needs to look like for them to want it. So I would be building a business, like if it's a lifestyle and it's an income stream forever, so be it. But if you're trying to build something to get crazy multiples, then maybe be looking at who's got a problem and how you can build something to solve it.
Okay, so again, we're looking at the bigger end of the market there. If we're looking at a small suburban pub, and again, I guess when you're looking at a hotel, you've got multiple revenue streams, whether it's the food, the alcohol, pokie machines,
Sure.
1, 2, 3 bottle shops in Queensland, all of which can provide the multiple income streams.
Yeah.
As a brewery, I guess you've got your over-the-bar sales, and then your wholesale business, and breaking down those and.
Yeah, there seems to be. I mean, like maybe your listeners would have a better insight into this than, or certainly will have a better insight into this. But I hear a lot in the industry that this magic number of 1 million litres per annum is sort of the. Once you start doing 1 million litres of consumption in whatever brewery you have, you start getting those economies of scale. You start generating some profit or some decent profit. You're out of the red. You're effectively into the black. And like I said before, it becomes very scalable. What I would say from a landscape point of view, and this is certainly not. I don't want to make this sound like a criticism at all, but when you have a craft brewery. The Bolters of the world have done it incredibly well, where they concentrated on that brand, on that on-premise presence, on that experience, the brand in hand, and then from there they amplified out. And that then became in bottle shops, like you said, and then they would have had a conversation at some point with ALH or Dan Murphy's or ABC First Choice or whoever it was, and managed to get the distribution out. And I think back to the earlier conversation about value and why crowdfunding is because you can have that model where your brewery and your tap house works really well, and then you can amplify out. But you have to be really clear on what your strategy is. Do you want it to be an on-premise, or do you actually want to get size and scale and have people ranging your products? And if you do, you need to have a very robust strategy around what that looks like from start to finish.
And I guess we are talking about a variety of different models based on whether you just want to be a tap room and a very small distribution, or whether you want to, but then the costs increase the bigger you become as well.
Sure.
And do brewers need to look very closely at what their model is, Peter, when they're
That was beautiful. That was perfect.
Okay.
Like if you got to decide what business are you in. If you are in creating a brand and distributing a product and going big for the lowest cost base you can, well, that's what you're doing. If you're a tap room trying to create an experience, you're not the same business.
Well, on that, Matt, I might bring Matt back in because we have seen, a business like Black Hops, for example, that has a very aggressive strategy. They've got a very, they've grown to a big distribution model. Some of the other crowdsourced funding models have tended to be a little bit smaller in terms of their, they just want to have a brewery and a tap room. Should they be valuing themselves the same way, or is it really up to potential investors to decide how they value that business?
Look, it's both, and again, I'll provide some more insight into our process. But as you're probably aware, we run an expression of interest campaign before every offer, and it does a couple of things. Like, it helps us assess how much demand is out there for the offer to help the company structure their minimum and maximum targets and things like that. But a company will be engaging with people that have expressed interest before the offer opens to test what they're thinking on their price, the pre-money valuation of the offer, but also their strategy, how they've presented the opportunity, any number of things. So there's an opportunity for investors that participate in an EOI process to actually give feedback to a company before they'll open the offer. As I mentioned, once an offer is open, we can't change anything about it, but there is an online discussion forum, which was actually a pretty innovative feature of the Australian law, that in real time people can ask questions of a company that's making a public offer of securities. So all of the information is there, and people can ask the questions. And I find it interesting. We're kind of sitting around here and analysing these offers. What a great thing! What a great time to be alive! That there is so much rich information about breweries.
Well, I'll just jump in there, because one of my criticisms of the crowdsource funding process is you have the expression of interest, and you're talking about how people can ask questions and things like that, and yet none of the breweries provide their balance sheets until after the offer actually opens. And that, to my way of thinking, there's a boiler room mindset that develops where and having participated in a lot of these, you get daily emails saying we're at 80%, we're at 90%, we're at 100%, and building pressure so that the day that it opens, you're going to miss out. But then how can a potential investor, given this is sold as an investment, actually ask a meaningful question in that expression of interest period when they don't have the figures, they don't have the balance sheet, they don't have the share structure and those sorts of things?
Sometimes they do. So, anecdotally, rather than kind of giving everyone the draft offer document before the offer opens, I understand that companies are in the practice of selecting a few investors, some that they might have already had a discussion with and, talked about the opportunity and shared the offer document in draft with them so they can, tune it up before they open it. But it's a good point that you make about, investors, investing and not having time to consider the offer. All investors have 5 days to cool off their investment. Another, innovative feature of the regime that was introduced to protect retail investors. So, that coupled with the online discussion forum and a detailed offer document, which, for the first time brings some standardisation for these opportunities. Investors have all of the tools there to be able to make a decision to invest or not. And, Peter was talking about data. I mean, that's probably the biggest opportunity of a thriving crowdfunding industry, is that over time, we will have more data points to assess the performance of these companies and to figure out, actually, has the right price been paid? Because I'm not convinced that all of them have got it right, but that's not really for me. That's kind of, for investors ultimately, and time will tell. And, not all of them are going to be a raging success, but, some of them might be. And with more data and more time, I think that this is a really, viable, and given what we've heard about, the bank's attitudes to lending to breweries at the moment, a really important and useful way for companies to raise capital.
It's certainly great for business owners. Paul, and I'm just very conscious of the time.
Sure.
Just bring it to a close. Should businesses that work, whether at the small end or at the sort of rapidly expanding larger end of the brewing business, should they have an awareness of what their business is worth? Is that a useful tool if you're just involved in the day-to-day of your business?
Yeah, absolutely. I think there are multiple tools that you should be aware of. I mean, as a business owner, I would say 100% you should know where your business is from a current valuation point of view. 100%. But I also think, on top of that, the other layer is you should be acutely aware of what levers as a business owner you are able to pull to maximize that performance and get the most out of it as well. So I mean, there's certainly, we spoke about several of them before, but there are certain business levers that you can move. You've got, through your business that will increase the value of your current business. I think you should absolutely be aware of what they are and how to maximize them. I mean, retail, we talk about COVID and how horrendous COVID has been, and absolutely, and the industry has been badly affected by it. It's certainly decimated by it in the on-premise, but the retail side of it has gone incredibly well. And I remember selling pubs 8 years ago, when, even maybe 5 years ago, when not a lot of people were interested in the retail side of it because it was dominated by the ALHs and the AVCs, your first choices, and there wasn't, a lot of money perceived money to be made out of it. Well, guess what? In Queensland, when you own a pub, you own 3 detached bottle shops, or you can. So those bottle shops became central to cash flow. Like all these publicans, when we were shut from March the 23rd to July the 4th, the only cash flow that they had coming through the door was retail. So I would suggest that every person that owns a business, whether it be a brewery, craft brewery, a tap house, etc., should be aware legislation, what levers they should be able to move to have a profound effect on where the business val is.
No matter what sort of business, we build valuation models so that somebody knows what it's going to look like at the next raise, so that they know what it looks like for a merger,
Yep.
so that they can talk to a bank about it, so that they can list it and understand where they're heading. It's fundamental to every potential transaction that you might be looking at.
And we might even look at doing a succession planning panel, because I think that's probably the next step in having a valuation, then working out what you're going to do with it.
Can I just add one point
absolutely.
to that? And I think that I don't want this point to be missed. I deal with a lot of publicans that I've known for a long period of time, and in my line of work, for me, a short-term plan is selling someone a pub and then walking off into the sunset and go, right, good luck with it. I have to, and I should be incredibly aware of anyone who's coming and buying a pub. I always say to them, what is your exit strategy on this? What are you looking at? You should be coming in at this price because that's the current valuation. But I've looked at the P&Ls. This is where I think the upside is. This is what you should be doing, and this is where you could get it to. And at that point, your valuation has gone from X to Y. And at that point, if you want to sell out at that and exit and ride off into the sunset, great. But you must have that plan.
Mm-hmm. Just very quickly, before we do go, do you think we'll see many publicans, in terms of the diverse revenue model, put breweries in? Are we going to see hotels?
Absolutely. Yeah, look, I'm already seeing it. I'm already seeing on a smaller scale already doing it. Yeah, because it makes sense on COGS, and I see a lot of cycles in this industry. There was a while back, certainly in Queensland, where there was a balance of land on a lot of pubs, so they decided to put accommodation on it, which was the right move to make, because then you've got people staying at 90 rooms or whatever it is. You've got people staying up in your hotel, and guess what? They come down, they have a bite to eat, they play on the pokies, etc., etc. You get additional revenue out of it. I think a lot of the astute publicans are now looking at it and going, hey, how can I extract the best out of every expense line item that I can here? And wages and COGS are two of your biggest. So why wouldn't I look at COGS? Absolutely. I've got a publican who owns coffee plantations in Papua New Guinea that uses the coffee through. He's got cattle as well that he uses for his beef. Like, it just streamlining against that middle or supplier side of things to bring his COGS down. Absolutely, it's an astute thing to do. And the result of it is that his EBITDA to turnover is incredibly impressive and better than certainly well above the average.
Peter, last word from you. Anything that you want to say about valuation?
No, just make sure you understand the nuances of everything.
I think we've teased out a lot of nuances.
Yeah, where you're going, what you're trying to achieve.
And again, we've had a very broad discussion across a whole range of things, but obviously speak to somebody who deals in this day in, day out. Could your average accountant work with it, or is it a specialty?
Well, everybody will have an accountant, and they will be helping them. It's how they're helping them and what they're doing, and whether they've got the relationships with funders or institutions or banks. That's probably the bit you'd be looking for.
Mm-hmm. Well, thank you very much for joining us for this Brewery Pro live panel. Thank you very much to Matt Vitale in Melbourne. Thanks for making yourself available, and
thanks, Matt.
Daylight savings and everything, Matt.
With any luck, I'll be able to get up there and join you for a beer.
I should say that we were hoping that we were going to be able to do this live, but those borders haven't opened yet, so hence the live stream. Peter Bishop, Paul Fraser, thank you very much for coming in, and happy anniversary, Paul.
Thanks.
So, I won't be sending you. I'll be sending you home with some champagne to make up to your wife for being with us tonight. And thank you very much for joining us for this Brews News Brewery Pro live stream. We hope to do it again very, very soon.